Is that up, Mark?
Yeah, that's up there now. Looks like West Connects or one of those tunnels. Yeah, I can see it now.
Okay, I'm just let me make sure we got the technology right. We appear to. There we go. All right, thanks, Mark, for hosting. I think this is our third presentation through the Coffee Microcaps, and I appreciate people coming on board today to hear a bit more about our story and the results of the last 6 months, and as we go into the rest of the financial year. So I think firstly, in case there's some people that don't know the Acrow story, I'll give a really quick overview of the history of this business. You can see there it was incorporated in 1950, but this Acrow was a long-held asset of Boral until about 11 years ago, 12 years ago. It was sold into private equity. I came on board about 8 years ago as part of the turnaround of the business through the private equity ownership, and then when we took the business public in April of 2018. The business has changed dramatically over that 8-year period. Certainly the last 4 years has been the real pivot, and I'll go through a fair bit of detail about what that's been all about. So you can see the key, I guess, numbers overview of the business. One thing I'll point out in terms of the share price at the moment, so we've had a 44% increase in our share price over the last 12 months. But as it stands at the moment, we're still trading at about a 7.5 times PE to our FY22 guidance number. So yeah, you can just make your own judgments about that. But certainly, you know, we've had a very strong performance in the market over the last 12 months. Revenue of $143 million. Now I'll go in more detail about that, but that's significantly up from where we were. Enterprise value 160. We've got a lot of very good equipment. Replacement value would be certainly in excess of now $140 million of our gear. And safety clearly is a very important part of what we do. And our lost time injury frequency rate has stayed at a reasonably good level for the last 4 years now, and going out certainly in this year, it's dropped significantly from where it was last year. The key financial metrics in the business for the first half, you can see they're all obviously going in the right direction. Revenue up 38% to 69 million for the half. EBITDA up 51%, 16.7. The things that we're probably most pleased about, and we've been saying for some time that we knew they would, the EBITDA numbers would start to roll through into NPAT and EPS, and they are. So, you know, 118% improvement in NPAT half to half, 93% in EPS up to 3.27 cents for half of the year. Dividend per share up 1.2 cents we've declared for the half, partly franked, and we are in a very heavy capital investment program at the moment. I'll go through more detail later, but you know, return on equity is improving over this period despite a heavy investment in capital, and you know, that's now going to be well in excess of 20% as we go through to the second half and the full year 22 results. In the first half, the main things that were, I think, key achievements. We are still primarily a project-to-project business. We rely very heavily on, certainly in our formwork business, continuing to win new work on an ongoing basis, and that secured hire contracts number is the key performance indicator for the business. So we're up 33% year on year to $23.4 million worth of hire contracts secured first half. The strong result that we're getting and the improvement we've had in our profitability is not off the back of any acquisition in this period. The last acquisition we made is about 2.5 years ago now. So it's now very strong organic growth, and a lot of that growth, if you look at the next one below that, WA, South Australia, Tasmania, that's growth that's coming out of the utilisation now of equipment that was not we didn't previously have opportunities to develop in those markets or sell into those markets or hire into those markets. So off the back of the acquisition of Unispan and also Natform that we've made, said, you know, Natform was about 3.5 years ago, Unispan was about 2.5 years ago. That's given us a broader range of product, excuse me, to be able to you know, open up new channels for revenue in markets that we didn't previously experience. And that's, you can see in those, what we classify as our smaller states, we've gone up, you know, 62% in revenue and 118% in sales contribution margins year to year off that broader offering. Sorry, bouncing around, but up to the top right-hand corner, the industrial services business is something we've grown significantly and will be a big part of the Acrow story going forward now. It's come off the back of the Unispan acquisition in Queensland, where we had about a $10 million a year business there. We've now expanded that into New South Wales in a big way, starting to do some work in South Australia. And so you can see, $21 million of revenue for half the year. That'll be closer to 45 by the time we get to the full year 22. Queensland Formwork is our strongest part of our business, has been for a long period of time. We've got better than 60% market share, and the activity level in that state is very significant at the moment. And off the back of maintaining, if not growing, that market share, we've had a very, very strong increase in higher revenue, 80% over this period. And the last point is an important one, and we're not immune to the issues that the rest of the world are facing with supply chain and logistics, but we've taken a very front foot approach to this issue. And what could have been a very big issue for our business has been minimised, albeit it's an effect. But I think we've taken the approach to try to turn a difficult situation into a competitive advantage, and we believe very strongly that we have. The major stimulus for us is our civil infrastructure formwork business. That's the major thing we focus on in Acrow. And you can see that there's, you've probably seen these numbers before about the growth in projected major transport infrastructure spend between now and over the next 4 or 5 years. One thing I will say is I don't believe that for a second, and that's good for us. It's not going to be that peak. It's going to be a longer and flatter peak. And I think, again, for us, that's a very good thing. We are primarily a hire company. We'll have gear out on jobs for a lot longer period than otherwise would have normally been the case. It is difficult to get labour on some of these jobs. It's difficult for the customers to get equipment. It just means it's going to be a longer and flatter process. And these projects are all basically government-funded projects. So you can see on the right-hand side of that page, we've got significant revenues coming off, most of the major infrastructure projects on the eastern seaboard. Bruce Highway, Croydon to Curra is our biggest project in the country at the moment. Interesting time on that project because they are pretty badly flood affected there at the moment. Again, that's not, unfortunately for the customer, but maybe for us, it's not necessarily a bad thing. Our gear is just going to be tied up a lot longer on that project than otherwise would have been the case. We don't cease hire. We don't do anything of that nature. If work has to stop because of those issues, we'll just continue charging. Melbourne Metro Rail, been a real success story for us. We're batting almost 100 on all new packages being let on that really significant project. Western Distributor, Melbourne, there's a really big package about to come out on the Western Distributor that I'm got my fingers crossed and I'm quite confident that we will win. Would be by far the biggest package that's been let on that project coming up in the next couple of months. Sydney Metro Rail, we're doing well on that, albeit we came a little bit late to the party on that project, but we're certainly not late to the party on the next stage of that, which is the Inner West Metro, where we're in a very good situation there to win some significant work as it's let, and the Brisbane Cross River Rail. You can see our formwork revenue by state and the growth that we've seen both nationally and by state. And then I will point out the one that looks like it's gone backwards, which is going to be a great story for us in the next 6 to 12 months. So Queensland, significant increase, 10 million to 13 million. You can see Victoria. Victoria's been our, no doubt about it, been our success story. We had very little market share in Victoria, back into 19. And you can see now where we've grown that to across 21 and 22, where we've gone from probably a 10% market share to being 40 to 50% market share in Victorian formwork off the back of our civil infrastructure focus now, engineering expertise. WA, great result for us. And that's primarily off the back of those new products that have gone into that market that have opened up new channels. And whilst the New South Wales number looks like it's gone backwards, it's a bit of an anomaly because in the 21 year, we sold a lot of second-hand equipment that was no longer required in the business off the back of rationalising our fleet from the acquisition we made of Unispan. If I look at pure hire revenue, which is the long-term profit generator of the business, 22 is a significant uplift from 21. And by the time we get to the full year 22 number, you'll definitely see New South Wales has grown its revenue and definitely growing its market share. It's the biggest market in the country. And you can still see that we've got revenue that's trailing Queensland by quite a bit and just sort of equal Victoria. Certainly believe we will see an uplift in New South Wales formwork revenue over the next couple of years. Again, higher contracts, one being the key performance sort of leading indicator. You can see that we've had 33% growth in first half 21 to first half 22, and that our pipeline is now at the highest level in terms of future work opportunities for us that it's probably ever, well, it definitely has ever been. And 90% of the work in our pipeline is formwork. We don't incorporate any of our industrial services shutdown work in here, as it basically goes project to project. This business has significantly pivoted in the last 4 years since becoming a public company from about a 50-50 revenue between commercial scaffold and formwork. It's now 85% engineered, what we classify as engineered systems, so formwork and industrial services. We've doubled the number of engineers working in the business in the last 4 years, and we are, I have no doubt now, by far the market leader in the formwork hire industry in terms of engineered solutions. We already had a very, very good team in this area, headed up by Matthew Caparella, who I've just promoted from National Engineering Manager to Chief Operating Officer, and we've been able to recruit a great guy in Evan Field has come in as the National Engineering Manager. We've probably got the 2 best formwork engineers in the country working for us at the moment, and I say that without boasting. I just think that's a statement of fact. We are now coming up with solutions that are not about price. This is about saving customers time and money, crane time, labour time, high quality, high safety. It's a very, very different focus to the old commercial scaffold. Put some scaffolding up around a 20-story building and compete with about 30 other companies on the contract. We're in a space here now with our engineered solutions for formwork and industrial services where we're only competing with maybe 2 or 3 companies on any major project. And in a lot of cases, we just get asked to put the package together and get awarded the contract without there even being a price checking situation going on. So I talked about some of the projects. So you can see we are on the major civil infrastructure projects in the country. The bottom right-hand corner is a Snowy Hydro. So this is very much in its infancy. We are already generating significant revenues on this project, but primarily from our industrial business, who are basically just building the camp for the workers. So we're providing a lot of access equipment while the camp is being built. I've no doubt within the next 2 years, that project will be our biggest project nationally in terms of revenue generation when all of the major tunnelling and formwork work kicks in, which is probably about 18 months away at this stage. A few case studies of what we do. Talked about the Western Distributor project in Melbourne being a very important project for us. This particular case study we put forward here because it's an example of how our engineers adapt to what's required on a job. So there was no system, no hire equipment system that could do what was required for this specific part of the bridge, which was a column and headstock on a 30-metre span bridge. So rather than throw our hands in there and say, sorry, we can't help you, we went and built a system and sold it onto the project. So we didn't hire that equipment, we sold it onto the project to do what was required. And it was a significant profit generator for us, and the customer gave them a solution when they otherwise wouldn't have had a solution. The next project is the complete reverse of that. So anybody who lives in Sydney who drives past the major Rosedale interchange, you can't miss our equipment at the moment. It stands out about 30 or 40 metres high above the road on the Rosedale interchange. This is the vent shafts for the tunnel. Now this was the complete reverse to the last project, whereas this project, the customer believed they would need to buy a purpose-built system and basically buy it onto the project for single use. We were able to come up with a design using our existing hire equipment and a very flexible piece of kit that we've got called Ulna RKS. And that has enabled the customer to save significant money by using a hire equipment solution. There's recently been a range of LinkedIn posts from this customer, CEDAR, praising the project, praising the solution, and very happy customer. And I'm very proud of our engineering team and design they've come up with. And the last case study I'm just going to mention here is primarily because it's a complete package of systems. 3 businesses: the old Acrow, Natform, which was the screens business we purchased, and then Unispan, which was a formwork business that we purchased with specialised equipment, all on one project. So we've got Natform screens, we've got a Natform hydraulic unit, we've got a Natform handrail system, we've got Acrow scaffold cup lock equipment, and then we've got UD-span mesh, and also CC4 formwork, which is in the bottom picture, the ground support formwork system. So that's an example of where we've now been able to put three businesses together, and in a lot of cases now come up with one engineering design that gets the whole thing done. Mentioned the issues with supply chain. It's there, and it's it's going to get more challenging now with the situation in the Ukraine. We've taken a lot of steps that have minimised the impacts of this. So firstly, we are in a capital intensive program at the moment. A lot of our gear and new gear comes out of mainland Europe and some out of China. And we were finding we were going to have significant delays in new equipment arriving. So we've established a very good second-hand market for some of our high utilisation pieces of kit that we found in North America. That has saved us significant money and significant time in getting that gear into the Australian market. And it's almost as new. We're paying around about 70% of the cost of new equipment. And for our customers, it's absolutely no issue when you consider that most of our gear that gets hired out is probably anywhere between 5 and 15 years old. So being able to just get that gear into the field, a lot more bang for our buck in terms of the dollars that we spend on it, and we've got it here quicker than we otherwise would. Secondly, a lot of issues around shipping container availability. We decided that we would go straight to shipping lines. We've established a relationship with Maersk, who are now providing us with containers directly rather than going through intermediaries. And our pricing with Maersk, albeit it's significantly higher container prices than what the country and the global economy was experiencing a couple of years ago. Our prices through Maersk are better than what we could get by going through a freight forwarder. And a lot of renegotiation around supplier trading terms. We've needed to do it. We've got a lot more working capital now tied up in this business because we are bringing in a lot more equipment for sale. Timber and ply products is an example. We were selling around about $500,000 to $600,000 of timber and ply products onto formwork jobs 12 months ago. We're now selling about $1.5 million a month worth of timber and ply products at better margins, but that does come to a cost of working capital. So getting the right trading terms has been really important for us in minimising that impact. So you can see in terms of the results generated, year on year, $69 million up from $50 million. And you can see formwork up by 5, big increase in profitability in formwork because it's all coming off higher revenue. Industrial services, which is a combination of higher labour and sale of equipment. So whilst it's up by $13 million, there's a $3 million improvement in margin, which is what we would expect with the mix of work that we're doing there. And commercial scaffold, which we still do a bit of, you can still a contributor to the business, is relatively flat year on year. The most important thing for me here is in a very significantly growing business with a lot of revenue growth, we're holding about 66% of our sales contribution margin improvement in EBITDA. So you can't run a business growing to this nature and hold your yard costs and hold your labour costs, but we are maintaining 2/3 pass through of the contribution margin going through to the bottom line, meaning 11 million becomes 16.7, and the margin goes from 22 to 24.1%. And you can see here in the bridge of where we've got that sales contribution margin, the biggest contributors are formwork hire, industrial scaffold hire, and industrial services labour hire. So about $8 million improvement in those areas, whereas basically where all of our capital is being invested into growing those businesses at the moment. So, I mean, that's what I want to see. I want to see that growth coming through off the back of our investment program. Our strategy has been very consistent for a long period of time now. We are the leading engineered formwork sales and hire equipment solutions provider in the country. We want to become the same in the industrial scaffold services business. Big focus on recruitment, training and retaining the best management. I'll talk about that in a second a bit further. Big program on generating higher return on investment organic growth by opening up new channels for revenue in all of our geographies. I mean, it's a big competitive advantage that Acrow has as a business, that we operate in every state, in every capital city, including Tasmania, Launceston and Hobart in Tasmania. We're the only national provider of services. No one can provide the services across the geographies that we can, or the range that we can. And we are a business that's interested in acquisitions. We've made 2. We've certainly got the lookout for something specifically in the industrial services space where, we've grown in New South Wales and Queensland and presence, a little bit in South Australia. We've got a very keen eye on both South Australian and Western Australian markets in that space. Talked about our people. We've been really successful in attracting some very high quality people into the business in the last 6 to 12 months. And just as importantly, we've made some really significant internal promotions. So I've said regularly, I've been involved in management for 30 odd years. I've never worked with a more capable, committed team of senior managers than I am at the moment within Acrow. And some of these, young gentlemen, well, they are young guys. Our Chief Operating Officer is 31, Matt Caparella. Jason Majan, who runs the Natform business, the screens business nationally, is a 29-year-old. Not on this page, but Jan Pinar, who's the Queensland GM, which is basically half our business, is a guy in his mid-30s. We've got terrific young people in the business and a great team overall. And the culture in the business is around safety first, but it's around about customer solutions off the back of that. What can we do that will generate the best result for our customers off the back of our engineering, design, and utilisation of our kit? In terms of internally, it's a very open, honest, and constructive culture. We are one team. It's very results orientated, though. Very demanding in terms of producing the results in the business. We have 12 grand finals a year. That's the result at the end of each month, and we have a Super Bowl at the end of June. Is the way we talk about it. Short to medium term opportunities: continue to grow the industrial services business and look at and potentially M&A activity in the west and the south. Grow the market share in New South Wales formwork. Keep capitalising on the project pipeline in Queensland. Continue that organic growth push into the other states off the use of new products and opening up new channels. Expanding our engineering service to have a more complete turnkey design solution for customers off the back of our new National Engineering Manager, Evan Field, who used to run his own business in this space. He basically was providing engineering design services to most of our major clients. And getting paid for that service. We're now looking to expand that into Acrow and to continue to grow our market share in our screens, Natform business. Lastly, for me, just outlook. We've just recently put an upgrade out on our guidance. We're now guiding to $145 odd million revenue for the year. We're guiding to sort of between 33.5, 34.5 in EBITDA, NPAT of circa 16, and EPS in the mid-6s. All those numbers, you can see, significantly up on last year. Clearly, we're 2 months into the year now. We know the January and February results. We're pretty happy with what we've seen for these first 2 months of the second half of the year. The reasons we can do these things and put this guidance out is the lead indicator around secured high revenue that I spoke about. Up to the end of January, that's now 43% up on the same time last year. We've got a range of CapExes that we've placed for orders of equipment that won't arrive now until March, June. We will get over 40% return on investment on that kit when it comes in. We're not factoring in. We're factoring in very little return on that in this financial year. Most of it will be in next year. And as I said, our industrial services division is now forecasting revenue of circa 43 million. So we're extremely comfortable with that guidance. As I said, we're now 2 months into the 6 months of the second half. So, we can say with confidence that the guidance is accurate. Thank you. So, Mark, any questions? I'm happy to take.
Just a quick one, Steve. The operating leverage as you move down from revenue to EBITDA to NPAT. I just wanted to dive a bit deeper in there. Is that purely from increasing volumes everywhere and better pricing, or the mix between the businesses? Or kind of all of the above, that's kind of driving that real expansion in operating leverage?
Yeah, look, it's a combination of all of that, and I think one thing to be recognised to start with, Mark, is that our equipment was already very highly utilised 2 years ago when we sort of went on our expansion program with capital investment. We're getting over 50% return. We target 40. We're getting better than 50% return on investment in the first year of any new gear that we're buying. So a lot of our growth has come off the back of we saw the market opportunities and we invested, and the growth in our higher revenue is now clear to see off the back of that. We are getting some improvement in prices. I mentioned timber and ply before. We used to be lucky to make a 12% margin on selling that as a consumable. We're now making, between 25 and 30% off the back of there being a difficulty in the world market for that product, and we've opened up some very good supply channels that some of the other Australian companies haven't been able to do. And so it's a combination of all of those things. There's definitely just volume growth. There's definitely some margin growth. And as I said, the thing I'm probably happiest about is that, this will continue going forward, even in a very significant growth period like we're undertaking. Where our overheads are not by any means growing at the same pace as our sales contribution margin. As I said, 2/3 of that growth is going through to the bottom line. And then I think just like finish on that, just in terms of NPAT. So we've been saying for some time, you will start to see our EBITDA flow through to NPAT as we get the scale. We're not the only area that's going up there is depreciation. Our finance costs aren't increasing, our tax isn't increasing, so the EBITDA improvement is basically flowing straight through net NPAT.
If we can just talk M&A for a second, I just wanted to kind of get your thoughts on, funding of M&A, given, you touched on valuation at the top of the presentation. So, using equity as part of any acquisition, or, raising money at this valuation to fund an acquisition, and just trying to get your thoughts on, taking debt on there, or just trying to, fund it out of cash and working capital, taking a back seat maybe for a half or 12 months.
So look, the two acquisitions we've made in the past, we're not done with equity. They were done in a combination of debt, vendor finance, and some issuing of script, if you want to call that, I guess, equity. But that's the way we've done the two acquisitions in the past. We are actually on a program at the moment to look for an industrial services business or businesses in Western Australia and South Australia, primarily, that would suit our sort of profile of the businesses, that would suit the strategy of what we want going forward. We definitely will not be overpaying on multiples. We don't pay more than sort of low 4 multiples on EBITDA for anything. If anybody wants more than that, they're talking to the wrong potential buyer. It very much depends on the size. Some of the companies we're looking at, they're anywhere between sort of $10 million turnover nationally to $70 to $80 million turnovers. So I think, clearly if we come up with something that's of a size of that sort of turns over $70 to $80 million, it would be a mixture of equity and debt. You would not do that all with debt under any circumstances, but a smaller one, you could probably still do it with a mixture of debt and cash. But I think we've had quite a lot of support from our major shareholders on this industrial services sort of push. I have at the moment in our $140 odd million of revenue, 40 of that comes out of industrial, and call it 100 out of others, and mostly the others is formwork. I would dearly love to see this business in the next couple of years have $120 million of revenue in each. That's what you get in the industrial services business, and you're dealing with power stations and paper mills and oil and gas fields, and they're the customers you're working with. It's a much more predictable level of revenue, and it's also, the margins are predictable. You win longer term contracts. We've got a 5-year contract, for example, with the Visy Tumut paper mill to do their shutdown every year. It generates $3 million of revenue and $750,000 of profit whenever we do that job. So I think we've had strong encouragement from a number of our major shareholders to, in the right circumstances, undertake M&A activity in that industrial services space to give us a more balanced business that's got a really strong formwork business, albeit it does have a degree of cyclicality about it, and a very strong industrial services business that won't have that anywhere near that same degree of cyclicality about it.
Okay, great. Steve, we're going to leave it there because you've finished for us nicely, exactly on time. So thank you for coming back to us and giving us an update on all things Acrow. And we'll keep an eye out for ASX announcements over the rest of FY22.
Good on you. Thanks, Mark, and thanks for taking your time to have a listen.